Well, hello, this is Paula White, and this is week 2 of Accounting 102. So let's get started. I just want to remind you that this is my email address, paula.white at independence.edu. And you do have me to be your support as well as Melissa Omens. Where are you, Melissa? Melissa Omens, and she has a schedule this month. Monday from 12 to 3 in the afternoon. Tuesday she's off. Wednesday 10 to 3 p.m. Thursday 3 to 9 p.m. for the evening, folks. Friday in the day from 9 to 4. And Saturday from 9 to noon. Take a note of her phone number, 719-445-1154. And if you're not in a location where there is a center to go in for the college, you can call her on Skype and do it virtually. Take advantage of your textbook, take advantage of these lectures, take advantage of the tutor. But when it's week 4, 2 hours before the end of the class, that's a little bit too late to be effective. So today we're going to be covering Chapter 7 and Chapter 8. I believe 7 and 8. Yes, 7 and 8. So Chapter 7. Accounting for sales and accounts receivable. Just so you know, Chapter 8 is the flip side of this. Accounting for purchases and accounts payable. Obviously, if you sell a company something, it's their purchase. It's your sale. You will have an account receivable. They will have an accounts payable. So it's two sides of the same coin. And that's why you have both Chapter 7 and 8 for this week. So merchandise sales. The objectives are to record credit sales in a sales journal, post from the sales journal to the general ledger accounts. So first, let's just review the type of journals used by manufacturing businesses. They have a sales journal, and that's to record sales and merchandise on credit. And you will see examples of these later. Then we have a purchases journal, and that's to record purchases of merchandise on credit. You have a cash receipts journal, which records the cash you receive from any and all sources. Then we have a cash payments journal to record all disbursements of cash, and a general journal, and that's to record all transactions that are not recorded in any other special journal, and all adjusting and closing entries are done in the general journal. Now, this is a deviation from 101, from Accounting 101, because in Accounting 101 and the first week of Accounting 102, every transaction was journalized in the general journal and posted to the general ledger. Now we have knowledge that there's 4 specialized journals, and we will soon find out that those journals in summary form will be journalized in the general journal, but not every single transaction. It will be a total, but we'll see that later. Now if we have specialized journals, do you think we'll probably have some specialized ledgers? Yes. So we have a general ledger, and that will be the assets, liabilities, owner's equity, revenue, and expense accounts. And the general ledger will still flow into the worksheet, which will flow into the financial statements. Now we have an accounts receivable ledger. Sometimes it's called a subsidiary ledger. And those are every single account receivable that we have for every customer that we have extended credit to. Accounts payable ledger has a T account in it for every single vendor that we have been extended credit from. So here's an example of a sales journal. As you see, sometimes we have arrows and sometimes we don't. As you can see, we begin on January 3rd. The sales slip number is 1101, and we have a customer, Ann, and she purchased $650 worth of merchandise from us, upon which we had to charge sales tax of $52. Those are both credits, as you can see from the heading, and the debit is to accounts receivable. So if we had actually not used the sales journal, we would have had to journalize to the general ledger each and every one of these, each and every one of these journal entries. Debit accounts receivable, credit sales, taxes payable, credit sales. Next. And you would just keep going down. Each and every transaction would have the same basic journal entry, except just different numbers. So we decided it would save work if we actually listed them in a sales journal. And then at the end of the month, debit accounts receivable for $61.56, credit sales taxes payable for $4.56, and credit sales for $5,700. So with a sales journal, it is not necessary to post each and every credit sale individually to general ledger accounts. So instead, monthly summaries postings are made at the end of each month after the transaction amount columns of the sales journal are totaled. And here's an example. At the top of this page is the sales journal. See it right here, sales journal. And this, the bottom in blue, is the accounts receivable account in the general ledger. This is the T account in the general ledger. So, step one, on the 31st, we're going to make a journal entry from S1 is the posting reference. That would be the sales journal, S for sales, journal, page 1. Number 3 would be the total of accounts receivable in the journal, will be the debit in the accounts receivable account. Step 4 would be a debit balance of $25.92 plus the new debit addition of $61.56 will get you $8,748. And last but not least, we're going to then take the account number from the ledger card 111 and put it underneath the accounts receivable total to tell us which account we actually posted to in the general ledger posting. So what are some advantages of a sales journal? Well, think about that for a second. Well, it saves time, effort, and recording space. It makes journalizing and posting more efficient. Personally, I've been known to transpose numbers, to not add the numbers up properly to get the correct balance in the accounts if I did all the stuff manually. we are all human, we make errors. So it will make the journalizing and posting more efficient. And it requires only 3 summary postings to the general ledger, which were sales, accounts receivable, and sales taxes payable to the general ledger at the end of each month. It does allow for the division of work. It improves the audit trail. And now, Section 2, accounting for sales and accounts receivable. The objectives are to post from the sales journal to the customer's accounts and the accounts receivable subsidiary ledger, record the sales returns and allowances in the general journal, and post the sales returns and allowances, and then prepare a schedule of AR. The accounts receivable ledger, or the subsidiary ledger for accounts receivable, has a card or a ledger card or a ledger account for each and every customer. Now, this is in the accounts receivable ledger, and here's a customer name, Ann. Oops. So here we have it filled out January 1st. That's the balance of $432. And I pointed out earlier in this recording that on January 3rd, she had sales step 1101 from the sales journal, page 1. She had a debit to the accounts receivable account and 2 credits. Remember, one credit was to sales and the other credit was to sales taxes payable. But this is the accounts receivable ledger, therefore it's everything related to it is the accounts receivable account. So now the 432 plus the new transaction of 702 will get $1,134 that Ann Ang now owes us. Now, when you call, if you have a credit card and you call the credit card company, MasterCharge, Visa, or whoever, there's an 800 number on the back of the card. If you call them, the first question is going to be, now what is your account number? Well, that is the way that they are going to access this same document for you for MasterCard. It will have your name up on the screen. It will have all your transactions, including your payments and your balance. So they will have the whole thing right there, but they will not have access to anything else. They won't have access to the income for the company. They won't have access to what you actually purchased when you made purchases. They just know that the company that you purchased from and the transaction number, and hopefully that will be familiar. This, though, is the accounts receivable ledger that they will be accessing when you call that 1-800 number on the back of your credit card. So here, note that the accounts receivable ledger has 3 money columns: a debit, a credit, and a balance. And the balance column is presumed to contain debit amounts because accounts receivable is an asset, and assets typically have a debit balance. So objective 3 was to post from the sales journal to the customer accounts in the accounts receivable subsidiary ledger. Each credit sale recorded in the sales journal is posted to the appropriate customer's account in the AR subsidiary ledger. So here we have the sales journal at the top, and then at the bottom, we have Ann Ang's accounts receivable from the accounts receivable ledger. As you can tell from the sales journal, January 3rd, the date got brought down. Sales step 1101 got identified. Step 3, page 1 of the S stands for sales journal. Step 4, the 702 debit to accounts receivable got debited to accounts receivable for An Ang. And step 5, 432 plus 702 is 1134. Oh, what happened there? Sometimes I just love Windows 8 for the current site. Okay. And the 6th step is to make a check mark by the posting reference. Okay, so now objective 4 is to record the sales returns and allowances in the general journal. That's the only place those exist. A sale is entered in the accounts records when the goods are sold or the service is provided. But what happens if something's wrong with the goods or service? The firm may allow a sales return or give a sales allowance. Think back, have you actually returned anything to a store? Well, when you purchased that item from the store, they debited cash or accounts receivable or even credit card receivable, and they credited sales. Then for a smaller amount, they debited cost of goods sold and they credited inventory. But now you turn and you don't like the shirt after all, and you make a return. You go back and you stand at the returns counter and you have your receipt in your hand and your shirt in your hand in the bag with all the tags still on it, and they give you your payment back in the method, usually in the same method of which you made the payment to begin with. So if it was a cash sale, you usually get cash back. If it was a credit card sale, you would probably get a reduction to the credit card balance, and so on. What is a sales allowance? Do you have any idea? Think about that for a second. Sometimes if you find a shirt and it's on the sales rack, it was a $20 shirt now on sale for $15. Well, you find that there's a button missing. But you have these same buttons at home on another shirt that's basically being destroyed as a rags, but you have the buttons. So it won't take that much to actually sew the button on. So this is a $20 shirt on sale for $15. You might be able to negotiate, go to the manager of the department and say, you know, the shirt is missing a button and it's on the sales rack. I'd be willing to buy it from you, but I need to have some money taken off of the sales price. What can you do for me? And who knows, you may be able to walk out of there with a $10 shirt. And the job now of sewing on a button, but then you have a perfect shirt. That's a sales allowance. So now, posting from the general ledger, here we have at the bottom of the screen, Linda Carter's, looks like her accounts receivable ledger card. And the top is a posting from the general journal. And this is a debit to sales returns and allowances. Now that is a contra revenue account. Because a revenue account we know is normally a credit balance, but this is a sales returns and allowance, which is reducing your sales. So it's going to be a debit to those accounts, a debit to sales taxes payable because you're reducing the amount of sales tax that you now have to pay to the government. And the payable is typically a credit balance, but we are debiting it, so it will be reduced. Then we're going to credit accounts receivable in the name of Linda Carter, and a credit to accounts receivable, which is a debit account, will reduce it. So each one of these line items in the general journal up here, each one of these line items are reducing the accounts. So now Linda Carter, we have the balance of $54. We have a sales step 1106 where she purchased and now owes us $486 on January 21st. However, 4 days later, she came back and she returned it, causing this journal entry. So what happens to her ledger card? On the 21st, she made this sale. We sold her the merchandise. So that's sales step 1106, S1, and 486. Now she owes us at that moment $540. But then on the 25th of January, there was a CM102. That's a credit memo, number 102. You see it up here notated also in yellow. And J1 is general journal, page 1. And we are crediting her accounts receivable account for $486. So now she only owes us $54. And here's a note that says 111 indicates the amount was posted to the accounts receivable account in the general ledger. The check mark indicates that the amount was posted to the customer's account. Now we have maxed out sporting goods, and this is a partial income statement. Just to show you how these sales are presented now with those contra revenue accounts. So we have a heading revenue, which is sales of $25,700, less sales returns and allowances $600 with an underline. Now our net sales is $25,700 minus $600, or a total of $25,100. And we continued on with this income statement. We would go into the expenses and then finally net income. Okay, so now we have a comparison between the accounts receivable general ledger account number 111. This is where we put the summary, the total journal entry that we posted to the ledger, $6,156. And now we have that cash receipts, which we haven't talked about yet, but this is the cash receipts journal, the CR1, and we received $2,133 of cash from our customers, reducing our balance from $87.48 down to $66.15. Now, from the accounts receivable subsidiary ledger, we were able to make a report for each one of our customers how much they owed us. And this is the $54 that we just did in the previous example. And the first line is Ann Ang. And so we pulled these from the accounts receivable ledger cards, and they total $66.15. And our general ledger, which was journalized with summary totals, is also $6,615. So we should feel good about that the details supporting the totals actually are in agreement. Now, what about accounting for sales and accounts receivable, special topics in merchandising? The objectives now are to compute trade discounts, record credit sales in the appropriate journals, prepare the sales tax return. Advantages of credit sales. What are the advantages of offering credit to our customers and therefore having credit sales? Well, the volume of both sales and profits should increase if buyers are given a period of a month or more to pay for the goods or services they purchase. The disadvantages are simply what happens if they don't pay. You're not going to get the benefit of any additional sales. You're going to instead lose on those sales. So here, sales on credit will lead to increases in profit only if each customer completes a transaction by paying for the goods or services purchased. And if the payment is not received, the expected profits become actual losses, and the purpose of granting the credit is defeated. And therefore, businesses need to closely monitor and analyze a customer's ability to pay before granting credit. So that is Chapter 7's presentation. And I'm going to go ahead and stop this recording, and I'll be back in a minute. So welcome back for the lecture for Chapter 8 of Accounting 102. I will get rid of my mugshot here. If only I could. Okay, looks like I did. And let's get that PowerPoint up. Slideshow from the beginning. So this is the flip side. Whoops. Okay, so this is the flip side of Chapter 7. This is accounting for purchases and accounts payable. So we have, I'm just making sure I'm trying to record this. We have section objectives to record purchases of merchandise on credit in a 3-column purchases journal, post from the 3-column purchases journal to the general ledger accounts. Let's see what this looks like. So we have, how are we doing this? The sales department sends an authorized purchase requisition to the purchasing department. The purchasing department issues an authorized purchase order and sends it to the selected supplier. A receiving report is prepared when the merchandise is received, and the accounting department receives the invoice and copies of the purchase order and receiving report, and they will not process payment until all of it's together and all of it has been reviewed by the appropriate person who has authority for a check to be cut. So let's look at cost of goods sold. We have the price of the goods that we acquired. So we're going to debit purchases, $550. But we had to pay freight charge of $50 to receive it on our receiving docks. So we had to pay for the freight to come in, and it's going to be called, the account itself will be called a freight in account. That's trying to get the purchases that we made into our business location. Now, you may be thinking, what about freight that you do for free for customers? Well, that would be called freight out And the freight out account is typically considered a marketing expense or a selling expense because it's an inducement for the customer to use your sales number to call and make an order because, wow, their prices are pretty comparable, but look, they ship for free and the other company doesn't. Who do you think will get the sale? Well, the freight out, you still have to pay for the freight to get to the customer now. And that's going to be called and categorized as a freight out account. And the freight out will be part of the selling department's responsibility. And now, the last one is a total invoice, and you have to credit accounts payable, $600, because it's purchases plus freight in, $600. The cost of goods sold account have normal debit balances, and as well as the accounts payable account has a normal credit balance. Now this illustrates every time you make a purchase, and in this situation we made a purchase on January 3rd, January 5th, January 6th, and January 7th. And look at all the work that's been done to just record purchases, a debit to purchase, a debit to freight in, and a credit to accounts payable. That's a lot of work to do those 4 journal entries, and those 4 journal entries are seemingly the same journal entry except just different numbers. So the note along here says these 4 entries require 12 separate postings to general ledger accounts, and it takes a great deal of time and effort to post them. And you remember how hard it is to post appropriately. So now, as an alternative, here is a purchases journal where we, instead of putting it to the ledger like here, we're going to put them into a purchases journal. Active designs on January 3rd, invoice number 5879, invoice dated January 2nd, terms are 210 net 30. We're going to debit purchases, debit freight in, and credit accounts payable. So in summary, we're going to debit the purchases account. Let's say that we're going to credit accounts payable, account number 205. Do you see the 205 here in the blue area? Account 205 for $18,795. There's the credit in accounts payable. The next column over, you're going to debit the purchases account. You're going to go to the purchases account and you see account number 501. And you're going to debit the purchases account for $17,540. And there it is. And then you're going to go to the freight in account, freight in account 502. And we're going to debit freight in for $1,255. And there it is. So all of these got replaced. If we had done them like this, we would have had a lot of work. This was a lot easier because the work was on this summary page, and then we totaled each column, and from that total of each column, that was the amount that we actually put to the 3 accounts in the ledger. 1, 2, 3. So objective 1 is to record purchases of merchandise on credit in a 3-column purchases journal. And we just saw that. And you enter the date, the supplier's name, and invoice number, invoice date, and credit terms. But we haven't talked about credit terms yet, but we will. Just be patient. And in the accounts payable credit column, you enter the total owed to the supplier. In the purchases debit column, you enter the price of goods purchased. And in the freight in debit column, you enter the freight amount. Well, I told you to be patient, didn't I? So here are where we discuss the examples of credit terms. Net 30 or in 30 means the payment is due in full in 30 days after the date of the invoice. Net 10 days EOM or in diagonal 10 EOM means the payment is due in full 10 days after the end of the month. EOM is end of month in which the invoice was issued. And this is an interesting one. So right now it's October 20 something. I think it's the 29th. So on October 29th, we can make a purchase, which is due, payment is due on November the 10th, 10 days after the end of the month in which the invoice was issued. So we have the 10 days in November and the 30th and the 31st in October. So we had 12 days to pay this bill. What happens if we waited to November 1st to make the purchase? Then we would have had the 30 days in November plus the 10 days in December because it's now due 10 days after the end of the month in which the invoice was issued. So what would you rather do? Wait 2 days to make the purchase and have 30 plus 10, 40 days to make your payment versus having to make your payment in 12 days. I'd opt for the 40 days. Or 2% 10 days, net 30 days, or 210 net 30. What that means is the payment is made within 10 days. Within 10 days, just send us 98% of the amount due because that's the 2%. What is 100% minus a 2% discount? It's 98%. So pay within 10 days. If you do, then you can pay the invoice minus 2% discount. Else, read the comma as else. In is net. Else, pay the net amount of the bill in 30 days. Okay, the purchases journal simplifies the posting process. Here, you're going to have the debits going from the purchases debit column, 17,540, and the freight in debit column, 1255, is 18,795. And we learned in Accounting 101 that debits have to equal credits. So you're going to have a credit to the accounts payable credit column, which is 18,795. They add debits and credits are established as equal, and life goes on. Post from the purchases journal to the general ledger in 7 steps. 1, locate the accounts payable ledger account. Enter the date. Step 3, enter the posting reference. Step 4, enter the amount from the accounts payable credit column. In the purchases journal, enter the credit column of the accounts payable ledger account. Step 5 is to compute the new balance and enter it into the balance credit column. And in the purchases journal, enter the accounts payable ledger account number under the column total. And last, repeat the steps for the purchases debit and freight and debit columns. So what are the advantages of a purchases journal? Think about that a second. What are the advantages? Allows division of work among different employees. Strengthens the audit trail. It records credit purchases in one place. And let's talk about accounts payable now. Our objectives are to post credit purchases from the purchases journal to the accounts payable subsidiary ledger, and record purchase returns and allowances in the general journal and post them to the accounts payable subsidiary ledger. And last is prepare a schedule of accounts payable and compute the net delivered cost of purchases. Demonstrate a knowledge of the procedures for effective internal control of purchases. So steps to post the accounts to the accounts payable ledger. 1 is to take down the date from the purchases journal into the accounts payable ledger. Bring down the invoice number. And number 3 is to bring down the posting reference. P stands for purchases, and this is page 1. So see here on International Sportsman that the amount is $600. You brought that down here in the credit section, and you added it to the beginning balance of $1,600 to get a balance in this account of $2,200. So objective 4 is to record purchases, returns, and allowances in the general journal and post them to the accounts payable subsidiary ledger. A purchase return is a return of unsatisfactory goods previously purchased for resale. And here's a guy in the returns line, and he said, "Hey, sorry, didn't like the color." Well, those gloves do look a little funky on them. Okay, so now we have posting from the general journal. So you're going to enter the amount of the return or allowance in the debit column and of the creditor's account. So accounts payable, International Sportsman. We're going to go down to International Sportsman and we're going to enter the date, which is the 23rd. I wish they didn't put these boxes on here. The invoice, $79.85 is the invoice, and the date is January 23rd. And here's your return of $600. So here we're going to compare the accounts payable account in the in the general journal, account number 205. And remember, we have accounts payable. We have a general journal. Then we have a purchases journal of a credit. And then we have a cash payment of $90,250. So in our general ledger account, we have $20,245. Then we go into our accounts payable subsidiary ledger and go into each account by each one of our vendors, and we put down the balance of each one of their accounts and total them up. And we're happy now because the details added up to $20,245, and the summary added up to $20,245. So it's most likely that we did everything correct. So the net delivered cost of purchases for max out sporting goods is calculated as follows. Purchases plus freight in gets you delivered cost of purchases $18,795. Less purchase returns and allowances of $100 will get you $18,695 net delivered cost of purchases. So effective systems have the following controls in place. All purchases should be made only after proper authorization has been given in writing. Number 2, goods should be carefully checked when received. They should be compared with the purchase order and with the invoice received from the supplier. The purchase order, receiving report, and invoice should be checked to confirm that the information reflected on the documents are in agreement. Computations on the invoice should be checked for accuracy. Authorization for payment should be made by someone other than the person who ordered the goods. And this authorization should be given only after all the verifications have been made. Number 6, another person should write the check for payment. Pre-numbered forms should be used for purchase requisitions, purchase orders, and checks. Periodically, the numbers of the documents issued should be verified to make sure that all the forms can be accounted for. That's the end of Chapter 8. So we just went through Chapter 7 and Chapter 8. So now I think it might be a good idea to go to your homework problem and give, oh goodness gracious, what happened to the homework problem? Well, give me a second here, and we will go through the problem itself, and I will give you some advice and some guidance. Okay, week 2. Week 2 assignment is worth 120 points, and it is due on Saturday by midnight. Let's just look at the template first, and then we'll look at the assignment. Okay, we have the sales journal. Down here, we have a tab for journals, and we have a tab for ledgers. I'm going to tap on, well, maybe I can't tap on. Oh, Well, we're in the journal section, and then we'll have this ledger section. So let's stay with the journal sections for the moment. Oh, come on. Where is my annotation? So here we have sales journal. We have a purchases journal. And you see where the items are in yellow. I expect entries in there. If you see something in yellow, that means that blank should be filled out by you. So here's a sales journal, and basically you put in the date, the sales slip number, the customer account debited. They have debit accounts receivable, debit, sales taxes payable credit, and sales credit. This right here would be the name of the customers, the customer accounts that needed to be debited. So that would be the accounts receivable account, the name. Okay, now I'm going to clear my drawing so I can page down to see what else is here. There's nothing else on this tab. Oh, I lied to you. There's sales, there's a purchases journal, and here's a general journal. Well, the general journal we just went over has to do with anything that a special journal does not take care of. And some of the examples in these two chapters were returns and allowances, both on the sales and on the purchases side. Okay. So now I just clicked on the ledgers, and we have the general ledger, and that will be by every one of our accounts. Just focus on the left side of the screen, general ledger, accounts receivable, account 111, followed by accounts payable, sales taxes payable, fees income, sales, sales returns and allowances, purchases, freight in, and purchase returns and allowances, the last account. So these account structures have already been set up for you. It's a limited number of accounts because this is trying to have you focus on accounts receivable, accounts payable, purchases, and sales. Now I'm going to move this over. So now next, and the check mark's good, we have the accounts receivable ledger. This is the accounts, remember over here though, we have the general ledger, and this is the accounts receivable account in the general ledger. This is the one that we'll get from the sales journal. The total will be debited here for accounts receivable. However, so we have the individual customers' records appropriately stated. We have an account for each one of our customers that we extend credit to. So this is Speedy Freight. As you see, there's no yellow, so I don't think there's any transactions for Speedy. Here's marketing, Pinpoint Marketing. Looks like they have a couple of transactions, followed by Able Landscape, Smith & Jones Builders, and Elite Computing. Oh, Smith & Jones Builders. And then we go down to, and here the check mark's good again, the accounts payable ledger. and we have a relationship with a vendor, Elite Computing, who has extended us credit. Now I'm going to erase that check mark. And talk about the schedule of accounts receivable. You know, this is the detail upon which it has to tie to the general ledger account. So why don't we just begin by putting in all the people who have account receivables with us. Speedy Freight and Pinpoint Marketing and Abo Landscape and Smith & Jones Building. And this is total. Since Speedy Freight has no yellow here, we can kind of assume that correctly they don't have any new transactions. So what would their balance of their account be? $1,400? I think so. And then you're going to do the same for Pinpoint Marketing after you do all the work for them, and then come down to a total. And then balance in the general ledger, question mark. I'll go to the general ledger and go to the accounts receivable account, this account right here. So what is its balance at this point right here? What is in the Y's? Let's say the sum total here is X's. So your X's for total should equal your Y's for total. Now here's your accounts payable ledger. After you do the transactions here, this schedule of accounts payable should be pretty simple. You only have one company in your accounts payable subsidiary ledger. And then you will put in its balance and what is its balance in the general ledger. Where is it? Accounts payable will be this number right here, which we don't know yet until you do the work. So does Z equal A? Z comes from the detail ledger in the name of the actual vendor, and then the general ledger balance is A, so Z has to equal A. So with that being said, why don't we get this closed out and see where these transactions are? Because we didn't see any in that spreadsheet. So here we say, as part of your New Year's resolutions to increase the success of the business, you've decided to offer products in addition to services. Additionally, you've decided to expand your client list by offering credit terms. You've learned the importance of properly accounting for your receivables using the accounts receivable subsidiary ledgers. Before taking on new clients, you create an AR subsidiary ledger account for your existing credit client, Speedy Freight. The terms originally were offered at net 30, and Speedy's Freight address is 123 Elm Street, My Town, YS, 10011. To keep things simple, just enter their existing balances as of January 1. So here's the accounts information about the accounts receivable subsidiary ledger. Targeted marketing to some local companies yielded some new clients. After a careful check of their ability to pay and payment history with vendors, the following clients are now seeking your services: Pinpoint, Able Landscape, and Smith & Jones. I remember those from when we were talking about the AR subsidiary ledger. Here's the addresses and the terms. They all seem to be net 30 terms. So now the accounts payable subsidiary ledger. Recognizing the importance of properly tracking receivables, you also recognize the need to create an accounts payable subsidiary ledger. Thankfully, you only have one account thus far, and that's Elite Computing, and the terms are net 90, which means you pay the net in 90 days. Notice the existing balance for Elite Computing in the templates. Now you have to record the following transactions. January 8th, you purchased merchandise. What ledger, what subsidiary journal or specialized journal do you put a purchase of merchandise in? Yes, that would be in the purchases journal. January 10th, you sell a new desktop computer. What journal do you put that in? Is there a specialized one that's appropriate? Yes, there is. It's called the sales journal. Then you have a purchases journal, and then you have a sales journal. Do you see a pattern here? Return $400 in merchandise. We said that the returns and sales allowances and purchase allowances will go directly to the general ledger and the general journal. Pinpoint Marketing returns the monitor. So January 26th, that's a purchase return. And January 26th, with the monitor coming back, that is a sales return. January 30th, Smith & Jones Builders request some networking help. And they want perform services for $2,500 on account. So now we're asked to, number one, make sure to record each transaction in the appropriate journal. Sales, purchases, or general. And make any necessary posts to the subsidiary ledger, like accounts receivable or accounts payable, daily. At the end of the month, properly total the sales and purchases journal columns and post that to the ledger. Remember, any entries to the general journal are to post immediately. And then you're going to create schedules for AR and AP. And you're going to confirm that the balance in each schedule matches the balance in the general ledger accounts. And that's the advice for your homework for this week. I hope that helps. And I'll say goodbye, and we'll see you next week.